Hello and welcome to Livewire Markets. My name is Chris Conway. Today I'm sitting down with Scott Kelly, who is the Group CEO at Real Asset Management. Scott will be sharing a little bit about his investment journey and the opportunities that RAM is pursuing. Scott, thanks so much for sitting down with Livewire.
Thanks very much for having me.
For those who aren't invested with RAM, can you just share a little bit about your capabilities and what you're trying to deliver for investors?
Sure. So we've been around for about a dozen years or so. We describe ourselves as a fully independent wealth and asset management business focused on three main asset classes, being credit, real estate and private equity. In terms of the real estate business, we operate in both the listed and unlisted spaces, focusing by a sector preference on retail, essential retail, so supermarkets, and on healthcare assets. In the credit business, our credit book's just a bit over $2.5 billion now. We've been doing that for around about 7 years. And so that's been a strong part of the business that's delivered strong returns and consistent returns for clients. If I said one characteristic that sort of cuts across our business, I'd say that we go for assets and sectors that are economically robust, that deliver solid, robust income streams, that grow ahead of inflation over time, and that provide capital stability, generally speaking, for clients.
Scott, can you tell us a little bit about your background and how you became Group CEO at RAM?
All right, as you may or hopefully be able to tell, by my accent, I'm a POM. So back home, I started at Mercury Asset Management and then moved on to Kleinwort Benson, to when I worked for them, two very British firms. So I think Church's shoes that I'm wearing today, chalk stripe suits, signet rings, lots of military analogies when we're talking about strategy. And also a time where Carol Galley was the second most famous woman in the UK, only to Maggie Thatcher, as she controlled a lot of the FTSE 100 shares. So a great grounding. And then I moved to Oz and briefly had some time at Macquarie before joining UBS, where I became a managing director. And I also got to know Scott Wheel, who founded Real Asset Management, which he eventually convinced me to join.
Scott, that's a fascinating background. What's the most important investment lesson you've learned over the journey and how does it relate to the RAM philosophy?
I've been doing it for about 30 years now, I worked out this morning. So I think maybe cutting through the noise. There's an increasing amount of noise in our lives and that's true of the investment world as well. So seeing through all of that and focusing on what's really important, I think is critical. Otherwise, I think you can make some poor short-term decisions rather than making some decent long-term decisions. I think secondly, I would say that remember we're in a cycle. Remember, it's not going to always be like this. And obviously as a real estate business, that's particularly true. But I think humans tend to focus and tend to assume that the status quo will persist. It never does. And so seeing through to the next part of the cycle, I think is critical. And that's relevant right now. And I'm sure we'll talk about that. And then finally, I would say, to think about risk more than return. I think people generally compare returns across different types of investments, but what's really important is to compare risks. There are lots of investments with similar returns. One might have a much higher degree of risk than the other, and I think focusing on return primarily as the driver is critical.
Scott, as you mentioned, you've got a strong presence in both real estate and credit. Let's talk about real estate and the current market conditions. What are the major trends you're seeing at the moment?
Well, I think I'd chop your question up into two, Chris. So I talk about the market, the long-term trends, and also the market conditions, because both are extremely relevant to what we do. In terms of the market conditions, clearly we're at the end of one cycle and potentially going into another one. So everyone will have a view on rates and inflation, but they may disagree only on when they're coming down, not if they're coming down. So I think in that late stage of the cycle, it's really interesting for us because what does that mean? It means that we can get access to really well-priced real estate. It was not so well-priced a few years ago, and really get set in high-quality assets for the longer term. So that's a real key for us at the moment in the underlying assets. And then clearly you've got, in the listed space, you've got the added complexity of market sentiment. That tends to be a pendulum, and it seems like the pendulum is busy swinging now. So those market conditions are really pertinent to us. And in terms of long-term trends, I guess the obvious one is healthcare. So so-called mega trend, we all know we're getting older, we've got more chronic illness. So we're going to see the doctor about chronic illness more. We're spending more on healthcare than ever, both preventatively and otherwise, at a personal level, a corporate level, a state level, a federal government level. So those underlying demand characteristics are undeniable, that the demand will outpace GDP growth, certainly in our lifetimes and probably beyond. So that really supports that sector. And we like to take exposure to real estate that is exposed itself to those sectors. So it's providing services that solve some of those or speak to some of those trends that we're talking about, so-called mega trend.
Scott, healthcare has been a strategic focus for RAM. Can you tell me a little bit more about that and what sets RAM apart from its competitors?
Yeah, I think our points of difference create those opportunities. So what I mean by that is, if you think about the managers that operate in the healthcare real estate sector, there's not that many of us, and I think not that many, and even fewer that have been operating in the space longer than us. So we've been around in that sector for about 8 to 10 years. So I think the time in the saddle creates opportunities because they naturally come to you over time. I think secondly, we talk a lot about operator-led opportunity, and what we mean by that is having a much deeper strategic relationship with our healthcare operators. There are about a dozen of them in Australia, and we work with all of them in one way or another. And what we try and do is take a really granular understanding of what they're trying to do, their strategy, and really solve for that from a real estate perspective. And I think that what that does is, it doesn't just give you a strong relationship, it gives you a long-term strategic partnership. Once you have that, then you'll get opportunities to solve their real estate issues, which will create opportunities for our investors. I think the other thing is patience. That's critical at the moment. I think real estate deals don't come along when you want, and they're not always the price you want. So you have to hold your discipline and you have to be patient. And I think we've shown we've done that in a disciplined manner through time.
Scott, in addition to real estate, where else are you finding opportunities at the moment?
So I think the other key part of our business is credit and fixed income. Think about public and private credit. Public credit, clearly there's an expectation that rates will be coming down. So in short order, we would expect that to be a favourable environment to extend duration, and I don't think that all of that is priced in yet. I think that's particularly true in Australia versus other markets. It might be more firmly priced in other markets, but I think there's still some uncertainty that you can take advantage of if you take, I think, a 2-year view. So that's the public markets. And then in terms of private credits, from our perspective, our version of private credits is very boring and predictable, just like the rest of the stuff I've been talking about, which is we've grown our book now to $2.5 billion, and predominantly they're residential regulated mortgages in capital cities in Australia. And that business is really growing well, so originating around about $250 million of mortgages a month, which creates an opportunity for us to build products for investors to invest in that broad business of credit opportunities. So we think that's a really exciting time to be in that space.
Scott, just to follow up, if I may, that $250 million that you're originating per month now, has that grown significantly, say, from a year ago?
It has. So I think as you go through that sort of loan origination cycle, we were doing about 200 a month about 18 months or so ago. Competition from the banks and other factors, obviously interest rates being one, drew that back a little bit, but now those headwinds have abated and we've been able to push on with that business. We create a pool of around about 5,000 loans that our investors can invest in.
Scott, nothing is perfect. How do you manage the risks?
I think, investing is essentially an exercise in taking risks. So I think you really have to be focused on that as the first port of call and build your process around eliminating unnecessary risks and monitoring risks that you wish to embrace and adjusting for those risks over time. I think that's important as you go on more generally, but also at the front end of the process where you're analysing new investments to go into, you need to have the same mindset and the same structure and the same discipline around that. I mean, that all kind of sounds like I've read it out of a pamphlet on the way here, and I'm sure it's not too different from other people that you've had in this chair. But maybe if I put some flesh on that with an example from our real estate business. So we had an asset, it was in our opportunistic fund. The three main risks that we faced, the key risks that we identified is obviously leasing, construction, and planning. So if those are the three key risks, how do we manage those risks? So we bought something that was 70% complete, which is an opportunity in that late stage cycle that I was talking about before. So we've mitigated much of the construction risk. We bought it, we took an option on it to buy at 50.25 million, contingent on the fact that we'd lease it up, so we'd reduce the leasing risk, or at least to the extent we wanted to, and that we had a change of use to convert it from what it was to a mental health facility. We did all of those things without parting with a dollar. So when we settled, we bought it for 50.25. The day after, it is worth $70 million. So
it's a good result.
Yes, it was. Yeah, and obviously that's the one I'm picking out.
Yep.
But yeah, so I think that's a real life example of identifying those key risks, putting it in a process, moving through the process, and having a good risk-adjusted return at the end of it.
Just to follow up there, if I may, Scott, with that particular deal, how long did it take from identifying the opportunity to then pushing it through that risk process and settling?
Probably about 6 months.
Right, so a lot of work goes into these deals.
Yes, oh yeah.
Scott, a big question to finish off with. How do you see the company evolving over the next 5 years, and what's the big hairy goal for RAM?
I think, to provide context, one thing we're quite good at in our firm is growth. So when I joined 8 and a bit years ago, we had $243 million under management. We're now approaching $5 billion. So we've kind of got form for growing. So when we think about the future, the way I think about it is to continue that trend. How we will do that will be different to how we've done in the past. We'll have an evolution of our client base. We'll have an evolution of our product. But we feel like we're now in a position where we've invested in our people, our processes, our systems to be able to cope with more clients and more assets. So we see that sort of trend continuing. If we do that, if we continue on the way that we're going, we get to around, in 3 years, we get to around about $12 to $15 billion of assets, and we get, more importantly, probably, we want to be known as a leading alternative asset manager in Australia. That's kind of what we've got in our mind, and we're in a big rush to do that. So I think it's a continuation of the trend. I'm sure if you ask the folks back in the office, they'll feel it's a bit more hairy and it's a bit more audacious, but that's where we see ourselves tracking to.
Sounds pretty exciting. Scott, thanks so much for sitting down with Livewire.
Thank you very much for having me again.
If you enjoyed that interview as much as I did, make sure to give it a like, and don't forget to follow our YouTube channel because we're adding lots of great content every single week.